everybody, and welcome to Masters of Real Estate. My name is Mathew Owens, and today I have my good guest on this line that has a ton of experience in both single family and multifamily real estate. Sean, thank you so much for joining us today. Really appreciate it. Love to get into what you're seeing out there on the market, and the different types of deals you've done over the years, and kind of pick your brain on this stuff for the best practices and ways to help people. But how can you give us a little background on how you got started, what your experience was before, what your job was before real estate, and why you love this space so much? You know what I mean?
Yeah, for sure. Matt, dude, super happy to be on. Thanks for letting me on your show. Happy to chat with you and catch up. So yeah, Sean Tagge, yeah, I did biomedical engineering in college. I
Okay.
was like, just do engineering, like it's one of the hardest things. Like if you can do that, you can find something. So right after college, did some artificial heart research. It sounds cool, but basically I was just under a bunch of kind of like, doctors and just doing their bidding and doing a lot of data, and stuff like that. It was cool, but like I'm more entrepreneurial. So I mean,
Right.
about a year in, I'm like looking for a house, and I've come across duplexes, and just did the numbers, and wow, it pays for the rent basically. Like, then when I move out, I can go get another loan and just start all over. So I bought a duplex in like 2015, and that
Okay.
just blew my brain. My little brain went crazy, because I was like stocks and trying to retire, you're planning, and it's just crazy cash flow. So that's just where it all started.
That's what I think I was in the same boat, working at the CPA firm. Just I was good at that stuff, but I became a CPA because there was too many girls at UC Santa Barbara, and I wasn't going to leave because they didn't have architecture school there. So that was why you're like, why do you do these professions? Sometimes you're like, I just picked it because I thought it was good, and and you don't realize till later on, like that doesn't necessarily fit your personality and what you really love doing and building wealth for yourself and stuff. And once you read a couple books, you're going, oh, wait a minute, what am I doing here? So what kind of gave you that inclination to look at, hey, let's buy this duplex, or let me buy a duplex in the first place? Were you thinking it could pay for itself, or were you thinking, hey, maybe I could try to support my own rent or something like that initially, or were you looking at it as an investment side?
Yeah, it was pretty interesting. I mean, I was just looking for single families at first, and then I saw a deal with like a mother-in-law apartment, and I was like, oh wait, you can have that rent. And then I saw, oh, you can qualify for a duplex to a fourplex with the same loan. I
Nice.
was like, so then I just, obviously me being an engineer, I math it all out, and then all of
Did
a
the
sudden
math.
started talking, and it just went nuts, And I was like, oh my gosh, like when I move out, this makes me $500 a month. Like that's amazing, for just coming out of college, like cash flow. And the pay down and the mortgage, principal pay down and the appreciation, it just blew my mind, blew my mind.
I noticed that there's a lot of engineers that transitioned out of that space into real estate investing, and it's probably because they all done the math. They start to do the math on it. They're like, oh, wait a minute, how long do I need to wait until I get all my cash flow covered, or all, or covering my expenses, right? Uh, so when you first started and got doing that, you started what doing, buying that duplex, and then how did that lead forward from there as far as your, progression of what you do now compared to what you do
Okay.
now?
Yeah, so bought the duplex, was just ecstatic about it, did the renovations myself. The first and only renovations I did myself. Spent like 8 grand, probably saved like 8 grand in labor costs, but
Okay.
it was a pain. I'm like, all right, I'm just gonna buy a good enough deal to where I can just work the labor in, you
Yeah.
know. And
Break your
I
back
mean,
on that labor. Yeah.
yeah, it's like everyone kind of learns. You got to do it. And I mean, I just started networking, networking, reading all the books, Rich Dad Poor Dad, and then Millionaire Real Estate Investor. That was a crazy one. Bigger Pockets, podcasts like this, hearing guys, like me, but 5 years ahead, and doing it. And my mind just blew. And started networking. I knew Cody Chamberlain. He was a friend of mine, and he's done a bunch of flips. And he actually introduced me to you, dude. Like, we had one call, I think it was six
Long
years
time
ago.
ago, right? Yeah.
And I started analyzing the market. So I analyzed like 50 markets, put it on a spreadsheet, growth, this and that. But I mainly did like rent and house price. And I saw that Memphis, Tennessee kept popping up as like the highest rent to value, meaning that had a high, home prices were low, but the rents were high. So I was like, well, you can cash flow good, right? You can pay off the mortgage. And I talking with guys like you, you blew my mind. Like you did like, I don't know, at that time, 400 deals or 200. And I was like, wow, like what a legend. I'm just working on my second. And and Utah kind of dried up. I did like one flip and then like a wholesale kind of partner up with guys. And then I just saw Memphis had so much more opportunity and cash flow. So then I started buying rentals over there myself and joint venturing. So I bought like two or three in 2016, and
Okay.
that's where it's ramping up.
Yeah, and it's funny. I did the same analysis in different markets around the country, and we started investing in Memphis and Indianapolis, Indiana, and Atlanta, Georgia at the time. And those
Yeah.
markets are much higher cash flow markets. So that if you're not successful on your flip, then you have rental income too, and you can build in some equity as well. You got to learn the hard way though, because there are some bad areas in some of these
Yeah.
areas, and I still remember driving through neighborhoods where people were cursing at me for being there, and you don't want to get out of the car, and but it looked beautiful to me because there was trees, and I'm coming from California, and it was like beautiful out there, right? It was kind of funny what misconceptions there can be about neighborhoods when you don't understand, a typical, area, right? So, but when you invested out of state like this, what kind of pushed you towards being able to take this to that next level and start to quit your job and get into this full time and start to really get you to that next level and that next piece.
Yeah. So, I just saw it, made it happen, a couple deals, networking, partnering. And then I just kept, now I got a little bit of a track record, right? Like, okay, this guy isn't a chump, right? He's actually doing what, he's doing it. He can make it happen. And that's where I just started networking. I was like, 2016, I was like, I got to do this full time. I do one flip, two flips, three, and I replace my income. Certainly
Right.
I can do like 12 a year, if I'm hustling like I am. And also in my other job, like I just got a 3% raise, like, oh, you did so good, Sean. You like worked your butt off. You got a 3% raise. Then like 6 months later, they gave me a promotion and I made like 25% more, like with a big promotion. But like, I was still just like bummed from that.
Right.
Everyone's heard it.
That
And
same thing exactly happened to me at the CPA firm. I went from like $33,000 a year when I first quit, and when I first
yeah,
was working there in 2000 to like 36,000 a year. And I'm like, oh, you're just killing me with this, right? You don't realize, and I'm trying to work for my CPA license as well, and they got you until you get that, like
right.
and so you realize that a lot of that is it's part of the system. It's a need to have people that are employees, but if that's not your personality, I did the same thing. I got my first deal under contract, and I quit my CPA firm job, and I was like, that's it. I'm not doing it anymore. You can't do it once you kind of make that commitment and that step, it's just like, no, your heart is there. So you have to be focusing on that. And what I call it real estate crack. Once you get that first deal under contract, it's really good. You got to keep going back for more. It's a kind of a funny analogy, but and so then you started really focusing in the Memphis market, and you said joint ventures with different people. How did you structure those deals? Because I really want people to understand how you can put these types of deals together. I was doing it as well on the joint venture side, but I'm curious as to how you structured those.
Yeah, so the one I did, it was just a flip. So I found it, we were gonna burr it,
Uh-huh.
and we basically refinance out, 80% of their equity. So I was like, hey, if we do this, I'll do it all. You put down the money, we use some hard money to buy it, and then we refinance 6 months later, and we'll go 50-50, on everything. And if we
Oh,
hit this hurdle of you get 80% of your cash out, which worked out. So it's like I basically just found a good flip, but instead of flipping it, we held on to it. And then, so I just did that just to start out. And then that's where I met my partners at Memphis Investment Properties. So 2017, I was talking to everyone. I was literally went to like the 10 people I knew in real estate that would like talk to me and like,
right, right.
and I'd be like, hey, I'm looking on going full time into entrepreneurship, real estate. I can become a realtor full time in Salt Lake. I could flip houses or wholesale in Salt Lake, or like maybe, man, heck, I might just move to Memphis. It's a great opportunity. That's where I'm finding my deals. Like I
Right,
could do something over there too. And the partners over there, they were just kind of, they were flipping, but they're just out, they're out of control, like growing way too quick, and they weren't
right,
organized.
right.
And they're like, yo, we need someone like an engineer, someone organized like you. Why don't, man, if you're serious about quitting your job and moving over here. So I flew over there, talked with them, and next thing you knew, we struck up an agreement. It's basically a JV agreement from the deals on.
Uh-huh.
I did a percentage of the deals from what sweat equity. And man, I quit my job and moved my wife and daughter of 1 year old to 24-hour drive away to east of the Mississippi, man, and quit my engineering job and
That's
just blew everyone's minds. I was like, what? Oh, dude, you're nuts. It was a little crazy at the time, I guess.
I think my mom did the same thing when I quit my job to go into real estate. She's like, "You just got a degree in accounting and economics, and you have a CPA license, and you're working as you're just gonna quit, And I'm like, "Yeah, sorry, I can't do it,
Yeah.
you still get the support, but you get the crazy eye look, like what is that, right? And I think it's important to go after your passion like that, and that's super cool that you found a company that you could step into and work with you on that side. And quite frankly, it takes some balls to do that, especially when you got kids and you're
Yeah.
trying to go through and have a family. I didn't have kids at the time, so it was easier for me to do that. Now I have a 6-year-old and a 9-year-old, and you have 3 kids, right? Is that right now?
Yeah, I got
Awesome.
8-year-old girl and then a 5-year-old boy and a 1-year-old son. So yeah, we're pretty close. Yeah,
Nice, nice. Yeah, that's awesome. The chaos is still happening, of course, at
it's
all
awesome.
times. So
I'm the man. I'm the
I was
funniest guy alive right now.
I was on a dad's podcast the other day. It was pretty awesome with getting to talk about the trials and tribulations associated with entrepreneurship and having a family, and the proper work-life balance and the ups and downs and the emotional roller coasters you go through as a parent when you do that. It's an interesting discussion. So back to the JV thing. That is a very, very typical strategy, right? You find an investor that has capital to put in on the deal. You're going to go do the sweat equity, help renovate the deal. You're going to go and manage the construction. You're going to find the property, and then you're going to try to refinance and pull out all their capital out of that deal. And as much as possible, sometimes you're left in the deal with some capital, of
Yeah.
course, if you can't get under a certain ratio, usually 75% loan to value or less, actually less than that, in order to compensate for closing costs and other things like that, depending on the cost of the deal, right? That's a great structure. You guys split cash flow long term. What we were doing we were doing that strategy, but also on the flip side, where we would split the profits on the flip if that occurred too. And then we started utilizing debt later on for those flips and keeping a lot more of the profits, of course.
Right.
But in the beginning, in 2008, when everything crashed, that's when people were running scared. You had to go give them a higher level return. But what we would do is in those fix and flip joint ventures, we would go through and build in an acquisition fee and renovation management fee. And then we started doing 5 of those a month. And those rehab fees and acquisition fees might be $5,000 a pop times 5 a month. And we're cool then. We're stable, been able to do more of those every single month. And that's how we kind of ramped up. And then later on, another joint venture strategy we utilized was when we bought them and renovated and tenanted them ourselves, we would sell them usually with a little bit of a markup to our joint venture clients, and then they would put 25% down and get the bank loan, have title, but we'd still get a piece of the cash flow and the equity long term on those deals for coming with built-in equity to the table, doing all the work, almost like a turnkey joint venture instead of a turnkey
Yeah.
sale out there. And those strategies, some of the biggest equity we've built is from those types of strategies, utilizing other people's money, because a lot of people don't realize you don't need your own money all the time, right? It helps massively, but you don't necessarily need it. So, and now you're focused a lot more in the multifamily space, right? What made you mentally transition from the multifamily or from the single family space over to the multifamily arena, and focusing a lot more in that area, other than the chaos of the kids and the family life, which is probably one of the biggest factors, I would assume. So,
Yeah. Yeah, so I mean, fast forward over the 7 years from 17 to 22, we flipped 1,500 single family like turnkey houses.
uh-huh,
And yeah, we just would sell them to investors in California, New York.
right.
It worked out great. But I was in the operations. So I became partner after 2 years, COO. I was just in it, running traction, getting things organized,
Awesome.
reducing our rehab costs. Because like when you're doing 200-300 houses a year, I mean, you save 1% here, 1% there, 1% there. I mean, it's hundreds of thousands of
Right.
dollars
It's a lot.
that you're saving. So I mean, that's what we got into, and then just getting the team smooth and like saving time. Like we'd create, little Zapiers or little automation things and bring in VAs and save our team, 5 hours a week for forever.
It's
And
huge.
things like
Right.
that. Yeah, it just adds up. So then we could be even more efficient and just even better customer service, and then growing our marketing and our brand. We grew our email list from I think 1,000, I got 500 when I started to like 13,000.
It's
So we
awesome.
just, that was the big, right, growing that, and the more people the more, the more you can move around.
People
So then,
people forget about the email lists and the importance of those types of systems and processes in the back end. And like you said, if you're growing too fast, it's really hard to implement those types of processes. You really need a full-time person that's focused nothing but those processes and systems. If you're growing like that, it's like otherwise you're going to fall on your face, and lose a bunch of money, right? So,
yeah, yeah, for sure. And just had like a thing with each person had like a little web page, and it showed what they do and their main jobs and tasks. And it was just awesome. Like we had scorecards, just seeing how people were doing, and it was so fun watching everyone thrive. We were having a great time. And then around 2019, 2020, started doing some like 100 units, 60 unit, 40 unit apartments. And after 2 or 3, we did with our own money, mainly my senior partner. He was, in his 60s, done real estate for a long time. Used a lot of his capital. I put a bunch of mine in too for me and myself at that time. So we kind of did 3 deals on our own and messed up with our own money, right? And didn't really make too many mistakes. Like we crushed it. We had like a 55% IRR on one of the deals.
awesome.
Like, I mean, that's just like, it sounds awesome, but like, I mean, really, anyone who bought in 2019 and 2020,
Yeah,
you're getting a great
you're
IRR,
good.
right?
Yeah.
You've seen rents go up like 20% in
Yeah,
20.
I thought I was a real estate genius in
Right.
2006 also, but then you
Oh,
realize you're like, oh wait, 2008. Your mistakes get covered up in a up market, which is awesome.
yeah, we
You got
say
to be more careful in the
rent
down.
cures all sins. Like, so if you're over budget on the reno by 10%, but rents go up 2%, 5%, yeah,
Right,
it cures those sins.
right. Yeah, for
And
sure.
cap rates go down. So that's where we kind of got that. So then we syndicated in 21 and 22, raised around 5 million equity on 200 unit and 180 unit, things like that. And yeah, those have gone well as well. So luckily we bought them at the right time, put in a lot of value add, like big heavy lift renos, 25,000 a door, raising rents like 400 a month per door. So these were highly distressed, 60% occupied type of properties, very dilapidated. And the thing is we're used to that. We're used to those heavy lifts. Like I wouldn't
Right.
suggest operators out of state, out of market doing that. Like, and so that was our niche.
It's a
We're other
big
guys
lift.
for clean, 10 grand a unit renos. And able to refinance like 80% of our investors' capital at, and now we got it,
Right.
fixed for 5 years or something like that at a pretty decent interest rate. And
Those types of heavy lifts though can really mitigate a lot of downside risk of the market, right? Because if you're now doing such a heavy lift that you're doing such a big value add to that project, you might be in it for 60 or 70 percent of the after repaired market value of that asset now, which means if there's a drop in rents or a drop in market value in those areas, you're pretty protected from your total cost basis as far as not losing your capital, right? And so now that you're able to get back 80% of the investor money, obviously there's still 20% left in, but that's a lot less of a risk than what originally was for those people. And being able to add so much value, you definitely have some built-in equity and stuff like that in that type of project, even after pulling capital out. So being able to do that, that's one of the best strategies, doing the BRRRR strategy on large multifamily assets. It becomes more difficult now with rates increasing and stuff like that, of course, but it's all a matter of those rents like you talked about and what happens with those rents long term and even in the short term, right? While you trying to enact this value add strategy, right? So,
yeah.
and then that was 2021 and 2022. And what are you focused on now?
Right. So 23, very beginning, getting burnt out. And you were saying it to me just barely too. First off, I'm in Memphis. My whole family's in Utah. I was kind of said to my wife, hey, we're here 5 years. It ended up being 7 because we're doing so well. And the market was crushing. It's like, why,
Right.
why we move? It's doing great. We're making a lot. It's awesome. And it's just all of a sudden, I'm a religious man. God kind of just put it in our way of just, it's a good time to kind of go. Interest rates, it hurt our business quite a bit. We
Right.
didn't like
Of
lose
course.
money per se, but we didn't make near as much.
Right.
Just with how things changed so much and on the flip of a dime, as you've seen from everyone. And things were slowing down. My partners were I was kind of wanting to go into 3 or 4 markets. We did expand into Nashville a little bit.
Okay.
And then, I was like, man, I want to be in 4 or 5. And, and there, my other partner, he's older. He's like, man, I just kind of want to wind down and just cruise, maybe only do
Right.
100 deals a year. And that's great. Like, dude, it worked out well. It's pretty amicable. Just like, all right, we got different paths. We
Right.
worked great together. It's a good time. and it's a good time to get back with family. And then I also wanted to really, I was like, I want to do, much larger multifamilies. Like we were doing kind of these, low end C class, 80K a door, 60K a door type of deals. I'm like, man, let's do the 150K a door, 200K a door type of deals. There's way more economies of scale. It's a lot easier, less risk because it's A class, B class type of assets, and so that's kind of where I transitioned 2023. Left the single family MIP, and now I'm on to multifamily. So I'm Acorn Equity and Acquisitions, and I'm partnered up with Compass Capital. So two of my buddies that I've been talking with for like 6 years, we keep, oh,
Keep
how'd
in
you
touch,
do
yeah.
it? Oh, you're doing multifamily, I'm doing single family. And so I'm with Sam Pro and Michael Whiteley right now. And we've just syndicated around 205 unit apartment complexes in Nashville,
That's great.
about 30 minutes from the city. And yeah, those were more like $30 million purchases and $10 million equity raises.
Those are some big raises. That's awesome to be able to, get to that level. And I think it's important to, what you're talking about transitioning your life, because, I've flipped 1,000 of these houses myself as well. And you get burned out, right? That many construction deals, dealing with that many contractors, dealing with we used to own a property management company. That's just like asking for problems, that you have to deal with, right?
Yeah.
Or your team does, which some of it will always fall on you to a degree, right? And, it's just going through a transition from, hey, I'm building my wealth, I'm hungry, I'm going to go crazy and, do 1,000 flips or, a bunch of holds on individual scale, to saying, hey, what is the right direction for me and the time that I want to spend on this, and how do I build this business to create the life I want? Because, we quit our jobs to go into this, to create financial freedom in our life and time freedom. And, obviously, as you had kids, I have kids now, you start to focus on different things, saying, hey, I don't want this much work anymore. I want to focus on my family and my kids, because that's the most important thing in life. No one says on their deathbed that they wish they worked more or they wish they made more money. None of that stuff really matters in life, right? And so if you know that inherently in the back of your head, you got to make a change at some point from a wealth building mindset and constant hustle mindset to how do you outsource as much of this work as possible and structure your business and the life and the income streams you're focused on to actually fit your lifestyle, right? This is one of the reasons I stopped flipping houses, and I basically just started, slowing down. I'm lending capital. I don't even lend direct anymore. I buy debt quite a bit instead and make interest rate spreads on that debt. I invest in different syndications as well, where we pool capital together, just like you're talking about, on multifamily mobile home parks, which I really love mobile home parks because of the value add potential there is pretty huge. And they're kind of the bottom feeders, right? You're always going to have a built-in tenant, no matter how good or bad that economy is, right? But multifamily acts in that way as well, depending on what you're doing, where if you're buying the right type of multifamily, maybe not the A-class stuff that can drop in rents, but B's and C's are a little more insulated because you still have the A's, and you also have the single family that can drop down to multifamily. So that is a more insulated market from major rent shifts. Now, each market is different, of course. So you want to, of course, look at the demographics of that market, which I'm assuming is one of the reasons why you chose Nashville. I think it's got some great, population growth and movement in that area as well. What are you finding in that market right now with regard to like value add projects? Like, tell us about a little bit about one of your latest projects.
So man, like we are so similar. I think like it's crazy. Like I could have said it all pretty much the same way, but yeah, like I pretty much spreadsheeted out like, okay, I can go, do singles on my own, go do and like I just found out like the time and the ROI on my time, like it's in multifamily where I'm at and what I've built, right? But I wouldn't be able to have the opportunity to do it without doing the single family and the resume I built, and the list we've built and the investors we've built. And then, like you said, the A, B, and C. So yeah, Nashville, A class, no, I'm a no on that right now.
Yeah.
Crazy in downtown. Like it's the 3 months of concessions of free rent, right? So we're in kind of the B minus, C plus, and we go from a C plus, make it a B minus, in the quality, a little bit older type of vintage. And that we're finding good deals right now. We're kind of riding the opportunity. It's, cap rates have risen, rents have kind of flattened out. And now what our two opportunities are coming with distressed sellers, not on the asset, but with the sellers in their portfolio. So they're having, their rates were locked in for 2 years. Now their rates are at 7%
Yeah.
on their other portfolios, and they need to sell because they need $2 million to refinance. They have to buy down the loan a bit to refi, and so that's what these two opportunities are. Is the sellers, they're not managing quite good. So there's a bit of value add too on the management, but mainly they just need to sell, and the market is right now where it's at, and they can't wait longer.
I think that's a good strategy, and to
Yes.
be able to find distress right now, because you see what happened with rates. A lot of people buying in late 2020 or early 2022 or 2020, mid 2022, and they did the value add assuming they're going to be able to refinance on short-term bridge debt, and then the rates went crazy, which what happened was people can't buy at the same price, so price values plummeted by 20% plus. They've had a major correction, but and now they're going to refinance and they can't. So you've seen a lot of people stop distributions or do capital calls on multifamilies right now because they can't go refinance at the same rate they thought, and so their leverage ratios are coming down from when they're trying to refinance, and then they can't. So they got to bring in more cash to be able to refinance and stabilize that asset, or be able to stack cash and not do distributions at all for that period to buy down to pay it down in the meantime, right? And so, and a lot of times what we're seeing too is someone that was mid rehab project comes in and they're right in the middle of a rehab, getting construction draws from the lender, and then the lender says, well, now the reserve requirements, you were on an adjustable rate, and now the reserve requirements are different because the rate difference. We're not giving you that draw, so you got to bring in more cash to get your operations to this level first before we're going to give you any more money on your draw. And they blow up the project because maybe they can't raise all that extra money, and which is difficult to do. It's way harder to raise on a deal that has had issues that you're having a hard time refinancing or getting your cash out than the initial project in itself, because you're in a distressed situation. So it becomes more important to have your operators have some extra cash strength and things like that too, or have some really good relationships to bring in more money. Is that what you're seeing out there? Is that type of distress?
Yeah, and it's usually not on the current asset, like the asset they bought a few years ago, so they have a few million, several million in equity, but they need to sell that equity to then go pay that $2 million, buy down and rate cap and all that on their other assets. That's the two deals we've kind of gotten. And what also is crazy is, like, I want to just iterate just patience. Like, we were all 2022 looking hard for deals, and we made so many offers and didn't get anything because it didn't make sense.
Right.
And then but then that squeeze happened through all of 22, and then 23, mid 23 is when all of a sudden we got two deals. So we waited like a year, 18 months of nothing, and then we finally got these two great deals. 15-20% below market with some decent $200, $150 a month rent bumps with like a very light renovation, 9,000, 10,000.
You realize that transition period, that 2022 mid 2023 period, when you're not finding deal flow, there's still a disconnect between what sellers thought that they could sell at and what they actually can sell at, because they are not considering what the buyer has to buy and pay an interest rate with as well. And the lenders kind of got through out there too, where they're lowering leverage ratios automatically. They're not sure where interest rates are going to land, and so they're being more conservative on top of that for the buyers too, because of that potential increase in rate that could occur, and wanting to lock in a shorter period. So you got this transition period. This happened during 2008 and all the way through all the way through 2012. You see changes occur where sellers don't want to sell, but in that situation there was so much distress that you're still able to find good deals during that period of time. I wish I would have just held all those houses. I would have had $50 million if I would have held all those dang houses. But
everyone's a genius holding for 10, 20 years.
Right.
And like you're saying, like, the ones where they're like, those are still, I think, still a year. They're kicking, a lot of people are kicking the can another year down, getting a loan mod or like extent. So like those will, I think, pop up for the next year or so. We're kind of getting the ones early where it's like they can sell and they really need to sell for equity to support their other portfolio. Well, at least from the two deals I've seen, right?
Right, right, for sure. And I've seen I've seen equity partners lose all of their money on some of these things as well, where
Yeah.
they're going back to the bank, you know. So we were invested in a deal that the operators, not a lot of money, but we were invested in a deal that basically the operator blew up, and they had, you know, probably 15 300 unit buildings and stuff like that that they just were out, you know. And so there are, you know, there is distress out there, but it all comes down to those rents, right? As long as rents are still, you know, pushing, and with the lack of affordability on single family homes right now, that pushes a lot of people into becoming renters. We may have some downward pressure due to, you know, wage reductions. I think I saw a chart the other day that we really haven't had any real job growth since 2018. Any job growth we actually have was primarily given to illegal immigrants that came here, and also second jobs that people are getting, or part-time jobs. So they're making the numbers look better than they really are, and so I have a concern about, you know, rent reductions in the near future or the next year or so that could potentially occur just because of downward wage pressure potentially, but that's counterbalanced by the lack of supply in the single family market. I think we're going to see a lot more combinations of housing and stuff like that occur, and more people per household that is, you know, living together. And this is what happened in a lot of different crashes out there. So what are you seeing potentially come up that could affect the multifamily or real estate market as a whole that you're concerned about?
I mean, everyone is living on, a lot of people in deals and in this kind of scenario we're talking, they're just living on that prayer of interest rates coming down, or being able to come in with a little bit more equity to keep it rolling. So, I mean, I just see pressure from that, and something's got to give. But yeah, yet again, it's different. This is different than 2008. These aren't
For
just
sure.
crazy, super crazy, stupid loans. They're pretty decently well put together,
Right.
and they have more equity, and, you know, not second loans and all this. So I see, you know, the pref equity is the big thing I'm seeing right now coming in. You know, they're getting equity on top, a 12-15% return, and they get paid out first. So I think that's what's happening, a lot of that, and then seller financing for people who have deals that are still at those good interest rates. Yeah, it's hard. I mean, but what I'm saying, I just see kind of an equal balance in, like, the bad and the good. I see it kind of equal for the next year or two, and then I see it, you know, easing up when they finally lower rates. I think in a year or two, then I think it just kind of slowly more more easily appreciates, kind of more normally, like a normal market we've seen.
Yeah,
Just
I hope they even out rates a little bit. I hope they don't drop them like crazy, because
yeah,
we already have so much inflation, and what's really actually happening is the Fed is pretending like they're coming in and fighting inflation through not raising or not reducing rates, but they're really opening up the backdoor cash flow stream for the banks, you know, behind the scenes, and adding inflation that way. Plus, with the amount of debt that, you know, and future obligations we have with Social Security and Medicare, and, you know, the pending, you know, issues, you know, globally with war and stuff like that. All those things are inflationary pressures that scare me into thinking that, hey, yeah, you know, they may not lower rates in the meantime, and so being careful in that regard, and they may raise rates if inflation rages. You know, we'll see what occurs. They're going to lie about what true inflation is, anyways. They took
yeah,
out
they're
housing,
absolutely
and
not good. Yeah,
yeah, they took out they put less weight to housing and stuff like that, and, you know, took
yeah.
out, like, I think like oil and stuff like that, and gasoline, and you're like, what? These are the things that went up the most, you know. So
Or
it was
whatever you
just kind
want
of
it to
funny.
be, I guess. Yeah, and
Right,
that's kind
right.
of, yeah. We, you know, as engineers, you know, we see that too with modeling and what people say the IRR is, and, you know, it just all comes down to trusting the guy underwriting it, and the team. And then, I mean, so what, you know, us, you know, I mean, there's all these macroeconomics. I mean, we're just looking for a few good deals. One a quarter is our goal. And we're just looking, you know, the basics, right?
Right,
Long-term fixed rate debt, making sure that's great, right?
right.
The equity and all of that coming in, and buying it at the right type of LTV. And then, yeah, I mean, day one, we're getting some equity day one, and then also with future value add on, you know, some renovations, right? Because you make the most money when whoever's swinging the hammer, right? When you
Hmm.
renovate, that's where the most equity is made, and that's where you can add value to your investors. And it's, you know, especially on these lighter value adds, it's a lot safer. When they're heavy value adds, I mean, just big things come up that you just don't know. Where these lighter, they're already in pretty good shape. You're not coming across crazy electrical, plumbing, foundation things, and it's things you can more control in the reno and be more within your budget. And that's what we've seen a
I
lot. we're within our budget. Where the heavy value adds, man, the budget is very hard to keep on task. So, yeah.
Yeah, I agree 100%. Like you have to really overly budget on the rehabs because costs of construction went up so much and labor has changed so much. A lot of what you think things are going to cost a lot more now, and so making sure those buffers are in place. And so I think the formula right now for good investments going forward is what first having a good conservative operator, right, in the first place, to make sure that you're investing with the right person that has those right processes and systems in place. You being, a COO, position in the past and understanding the operations is huge from a operational, efficiency standpoint. But that piece is number one. Number two, having conservative debt, right? Those 10-year loans that you're talking about as well, super important to be able to mitigate that long-term interest rate risk across the board. Try not to get a prepayment penalty or lower it as fast as much as you can, just because of the fact that if rates do drop, you want that opportunity and have it not to kill you on points for having to refinance early or something, right? So those types of things pay attention to. And then not leveraging so much, right? Actually taking it easy a little bit, not leveraging to the hilt if you can help it, unless you're getting all your investor capital out, then cool. But at the end of the day, not leveraging so much so that you have a little bit of bandwidth or buffer room for potential issues that could happen with the economy, like rent reductions or increases in expenses and things like that could occur to weather any potential storm downstream. And I really love investing in value add projects like we just took down a 172 unit mobile home park, and
Nice.
in that mobile home park, we're adding 52 new units to empty slabs and then rehabbing 26 down units. But there's a lot of risk to that, right? Of course, from the rehab overages, we had to buffer that like crazy, but
Yeah.
we're ending up at a 13.8% cap rate at our cost based on once we're finished, where it's like 60 cents on the dollar. So we could be off by 20-30% or call it 20% and still get close to covering all of our monthly or getting all of our investor capital out on refi, so it's really interesting to be able to add that value. Even though there's risks to the rehab, if you have the right operator, it protects you long term with that equity gain and that buffer room you get. So but Sean, this has been really, really awesome getting your feedback on all this stuff, getting your knowledge base on what you're seeing in the multifamily space. If people want to reach out to you and get to know you more and understand what kind of deals you're doing, how do they get a hold of you, man?
Yeah, I mean, I'm on LinkedIn, Sean Tagge, pretty easy, unique name. And then, my website, Acorn, EA, stands for acornequityacquisitions.com. I got a little bit of info on there. But yeah, man, happy to reach out, help out in any way to anyone.
Awesome. And if anybody needs any extra help, you can go to MathewOwens.com with 1T in Matthew. We have a free due diligence checklist on there, a property analysis sheet, a couple master classes. So anytime we can be a resource, please let us know. Thanks so much. Appreciate it, Sean, and we'll talk with you soon.
Thanks so much, man. Have a good one.
Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.